to discuss the difference between the standard deduction and the itemized deduction. And I know we've hit upon this a lot throughout the class. So this is probably somewhat of a review, but again, we're going to delve much deeper than that. So you've all been pretty aware of the little box on the side of the 1040 that deals with the standard deduction amounts. We've talked about that from probably week 2 or 3. What we haven't talked about is the specific line item here that says standard deduction or itemized deductions, and we're going to focus on Schedule A. So I'd love for you all to get out your Schedule A, pause the video, get it out in front of you so that you can review along with me. When we talk about these deductions, and again, they're right here, right? Your standard deductions amounts, and I don't expect you to memorize them, but notice that they are single and then double for married filing jointly or widower with a dependent, and then head of household is somewhere in between there. These amounts change yearly. They're adjusted for inflation and standard of living, so they don't stay at those amounts. Last year, for example, they were $12,000 and $24,000. They roughly go up by $200 every year, but that can change. So remembering that taxpayers who cannot take the standard deduction and must itemize, meaning they don't even have the option to take the standard deduction, is if a person is filing as married, filing separately, and the spouse itemizes. And this would make sense because let's say, for example, a spouse is going to recognize all of the expenses for the medical, all of the real estate taxes that we're going to talk about, and those itemized deductions, if just taken on one of the married couple's tax return, exceeds the standard deduction, they're going to benefit. But then let's say that the other spouse, the other person in the relationship, takes the standard deduction and no itemized deductions. You can probably see that the standard deduction for one spouse is going to be higher because they didn't have any itemized deductions since their spouse took all the itemized deductions there. So that is one of the restrictions. And non-residents and our tax returns are one of the other restriction there. Notice that standard deduction is going to be automatically calculated in the basic information section. So for example, if you enter in the real estate taxes and things like that, and they don't total more than the standard deduction, tax layers automatically put down the higher of whether it's the standard deduction or the itemized deductions. There's also an item for age and blindness. And I know we've dealt with this already as well, but we're going to go into a little bit deeper here. Notice that the standard deduction is higher for a taxpayer or spouse 65 or older, or if one or both spouses are blind. Notice down here, this bullet point down here, we're not going to delve too much in the, I'm not going to make you open up your tab E in your booklet, but that's where it is. Instead, we'll focus down here. Notice that taxpayers can take the higher standard deduction if only one spouse is 65 or older or is blind, and if they file a joint return. So they're filing joint and one of the spouses is 65 or older or blind, and if the taxpayer files a separate return and can claim them as an exemption. This one right here, I would cross off because I would absolutely cross this off here because we don't file exemptions anymore. Those were called personal exemptions, and they're not part of the 1040 form. So the IRS needs to take that out of their offering, PowerPoint offerings, in my opinion. Notice that taxpayers who can be claimed as dependents still can take a standard deduction, but it's going to be for a much lower amount. So keeping in mind that if somebody, let's say maybe even you guys are claimed as a dependent, by somebody else, you can still take a lower standard deduction. And I don't know if that amount is here or not. It is changes every year as well, but it's a couple $100s. So remembering, we're not going to deal too much with this here, because when we get into the next set of PowerPoints, which I'm just going to continue with the lecture, we're going to talk a whole bunch about the itemized deductions and Schedule A here. The majority of what we're doing here is going to be medical, state and local taxes, mortgage, and then we'll talk a little bit about gifts to charity, but other things such as casualty losses and things apply to that as well. I think the last thing we're going to talk about, is the kiddie tax. And if I had to equate anything to the kiddie tax, it would be a trust fund baby. We've all probably heard that term before. And the reason it is a trust fund baby type of situation is because of this word right here. This word right here deals with unearned income. Notice that children under the age of 18 and certain older children, these certain older children we're going to find out are 19 to 24 if they're a full-time student, which you've seen that before as well. If they have unearned income, and when we think about unearned income, it's somebody that's not working. So it would definitely be something like interest, right? Interest from a trust or something of that sort. So they get income over a certain amount of this interest, let's just say, may be taxed using tax rates applicable to trusts and estates. So they, in other words, we're not going to get into the exact amounts because those change, but just know it's a fair amount of money that these trust fund babies get for unearned income. So in other words, it is not earned, it is not on a W-2. So if the child's unearned income is more than the ceiling amount, which changes all the time, they're required to file a tax form. And again, don't memorize the tax form to figure out the child's tax. There's the form. Notice that it must be filed if their unearned income was higher than the ceiling amount. So in other words, if the ceiling amount is $10,000 and if they earn more than that, then they would have to file the form. The child is required to file a return for the tax year because it's over that amount. The child either was, and here's your age restrictions, under 18 or was age 18 and did not have earned income, so no W-2. And here we go, was a full-time student, 1924, as we've talked about before. Also, one of the child's parents has to be alive at the end of the tax year, and they don't file a joint tax return, meaning that they are not married. So again, I kind of equate that with a trust fund. We are not going to cover qualified business income. We're not going to do it in VITA, so we are just going to skip it. That ends this section of it. We're going to then dive right into the itemized section here. And the itemized, again, I'm going to skip back and forth between the 1040 form and Schedule A and this slide. So hopefully, because I'm skipping all around, you'll have the 1040 in front of you and the Schedule A in front of you as well. So the itemized deductions here are, again, if a taxpayer would itemize when they believe that they're going, by itemizing, they can exceed their standard deduction. And if we look on our 1040 form here, notice when we get here down to line 12, and this is why I want you to hopefully have it in front of you because it's kind of small print. Line 12 states standard deduction or itemized deduction on, again, line 12. Notice that that is used to reduce adjusted gross income, line 11. That amount is used to reduce adjusted gross income to get to taxable income. All right, so we have our W-2 wages and all our pensions and all that good stuff in here to give our total income, which is on line 9. We have adjustments, which we dealt with already in the previous week lecture, gives us to total AGI. Maybe you've heard AGI before. Then we reduce it by our standard or itemized to get our taxable income. Taxable income on line 15 is an important number because that is the amount that is going to be taxed. So as we look at who should itemize, who should pay these things, who should itemize versus the standard deduction, all of these things that are on the Schedule A are going to come into play. Of course, if somebody should itemize, if the total of the itemizations are higher than the standard deduction, whichever one benefits the taxpayer. Let's look into medical and dental expenses. There's a lot of different medical and dental expenses that we can talk about here. They are generally things like, let's say they're generally things like, of course, prescriptions. Oh, I don't want that. That's awful. Prescriptions right around there. Any types of bills that you get from the doctor's office if you had a major surgery, anything like that. What is even included in there is travel to and from the doctors. That also includes the dentist. It includes eye appointments. Anything that's medical related is going to be in there. If you look on your Schedule A, you're going to notice on your Schedule A here that you have a limitation. So what I want you to do is, I'll get your calculators out, and let's say that you have medical and dental expenses of $10,000. And I think it's important for you guys to follow along and do the calculations as well. So let's say you have medical and dental expenses of $10,000. You had a major surgery. If you have line number 11, which is, I believe, your AGI, I'm not going to pull it up, but I think it's your AGI, adjusted gross income. Say you made $30,000. Notice that line 3 here is multiply line 2, which is your AGI, by 7.5%. And I'm going to do that now as well. I think it's 2250. It's 0.075. Yep, 2250. So we're going to put in here 2250. Stop for a minute and notice just what happened. We had line number 1, which is our total medical and dental expenses. We had line 3, which is a percentage of our AGI. Line 4 says to subtract line 3 from line 1. And that is 7750, and put that here. So notice what happened here. Yes, we had 10,000 of medical and dental expenses, but that was limited by 7.5% of our AGI. So the amount that is going to go here is 7750. Notice also that if line 3, right here, our limitation, is more than line 1, you can't take anything. So if your medical and dental expenses, for example, totaled $2,000, this would be 0 because your limitation, which is the amount of your percentage of your AGI, is higher than your actual medical and dental expenses. You can read up on everything else that you wanted to if you wanted to fall asleep at night, referring to publication 17 on that. Taxes that may be deductible are state and local taxes, sales tax, or real estate taxes. Notice again on Schedule A what happens here. Sales tax can be taken. Sales tax is up line 5A here. So line 5A is dealing with sales tax. And just as a reminder of sales tax is the tax that you pay when you buy things, right? You go to Target, if you, maybe it's 5%, in certain counties, it's by county, and you pay a percentage on everything you buy. Notice what's going on here. State and local income taxes. This comes from your W-2. right? It's automatically populated from whatever you put in text there with your W-2. And in line 5A, it says state and local income taxes or sales tax. You may include either income tax or sales tax on line 5A, but you can't do both. If you elect to do sales tax, check this box. So you're often probably saying, like, why in the world would I do general sales tax? Because I'd have to keep receipts and all that jazz. Let's say you buy a big boat, right? And it's like, we're gazillionaires, right? $1 million. That sales tax may be more than you earned. Pretty unlikely if you can afford a boat like that. But if you're a trust fund baby and having to pay kitty tax, it just may happen. So depending on what you buy in any given year, that could be substantial. But again, you'd have to keep receipts. The majority of people are going to pay whatever is out of their W-2 information. Notice also here that we have state and local real estate taxes. Taxpayers would get a Form 1098, which would on it show both your interest and your real estate taxes paid if your real estate company pays it on your behalf. If they don't, meaning, let me repeat it, they don't pay it on your behalf necessarily. You pay it as part of your interest payments to your mortgage company, and then they remit it to the county. If your house is paid off, or you just elect to pay the real estate taxes yourself, then you would just write a check to the state auditor's office there, the county auditor's office, my bad, sorry, and keep receipts of that. So notice that real estate taxes are on there. Personal property taxes, very similar to real estate taxes. And then you add those lines 5A, B, and C, put that number on D. And then notice here on 5E, you enter the smaller of line 5D, which is the total of those taxes, or $10,000. Again, we've got a little limitation there. And you can enter that then when you add all those up is on line 7. Interest. Interest can come in the form mostly of mortgage interest, but it can also be points paid as a form of the interest. If you've never heard of what points are, when you purchase a house and on that mortgage interest, you don't necessarily like the interest rate, you can pay money up front called points to lower that interest rate. And I'm not going to get into the calculation of which one is better, but of course Excel can definitely produce which one would be better, paying out of pocket with points or saving that amount of money on your interest. So those things that are on that interest line item on 5A, here, interest you paid is, notice that we have home mortgage interest and points. If you didn't use all of your home mortgage loan to buy, build, or improve your home, check this, meaning, let's just say, for example, used it for home repairs or something like that, or on a rental or something like that. Notice have home interest and points reported to you on Form 1098, and then any home interest not reported to you on 1098. Let's say, for example, your cousin lends you money, charges you interest. That's still going to be allowed, even though it wasn't from an actual mortgage lender. And of course, your cousin wouldn't necessarily provide you with a 1098, but it's still deductible nonetheless. Gifts to charity. Going on your Schedule A, you're going to notice that there's gifts to charity. Going on your 1040 that's in front of you, you're going to notice that there's gifts to charity. So if the amount of gifts to charity, and this is just this year, it can change again, like we've talked about, the gifts to charity are $300 or more. Notice on your Schedule A, you would include that amount on your Schedule A. If it is $300 or less, it can go directly onto your 1040 to be able to reduce the taxes that you pay. There is a list of certain organizations that you can contribute to. You know, contributing to your friend's GoFundMe page because they got a noise complaint and have to go to the courthouse. Not an exempt organization. Things that are on an exempt organization list would be churches, of course, not your nonprofits like Veterans Associations and American Diabetes Association, the SPCA, those are all on there. There's some miscellaneous deductions as well. And you notice here on Form 1040, or Schedule A, I'm sorry, you have these other itemized deductions and then just a random list there, like listed right here. Very deceiving, because on these miscellaneous deductions, it can include things like gambling losses and work-related expenses. This is really important here, only for disabled individuals. This is a new change. Notice first here that this 2% are not allowed through, we've got this limitation through the end of 2025. This really hit the Caskey house hard. Employee business expenses is on there. So any person that's generally in sales, they pay a lot of fees for like tolls or taking business folks out to lunch or buying donuts for clients or whatever. If your employer does not pay you back for those things, you used to be able to take it as an employee business expense. Now notice that itemized deductions that, for example, this employee business expense that used to be under this 2% limitation are not allowed now through 2025. The reason being is this was probably, I'm guessing, fraudulently put on the tax return, and most companies now will pay and reimburse for that. So anything on that miscellaneous deductions form, unless it's like gambling losses and disabled work-related expenses for disabled individuals, probably not going to have anything on there. That ends our lesson on standard and itemized deductions. So you'll of course have a pre-quiz on it. So let me know if you have any questions related to it. Otherwise, I will see you in class.